Okay, so we had a downward revision on job growth, second biggest ever in history. We have 4.3% unemployment. That's up from 3.5. That's a rapid increase. That kind of triggers that SAM rule. That means every time SAM rule has been triggered, recession is likely to follow. We now have a Fed that is saying they are going to cut the interest rate in September with all likelihood. The CME group is projecting a 100% chance that there will be a Fed rate cut in September. The markets have that fully priced in. One of the reasons why we didn't see much movement on the 10-year this week, 30-year fix still hanging around the lowest point it's been at in over a year at around 6.5%, according to Mortgage News Daily. If job growth, or rather unemployment, continues to move up sharply, that would have an impact on the 10-year. That would cause the Fed to cut even sooner and maybe more rapidly than they're saying that they will. What's going to be the impact here on all these dynamics here? We're in an election year. Maybe that's why we haven't gotten great data throughout the year, or maybe the data has been way overstated in comparison to other years. Again, second biggest revision downward ever on jobs. If the job market and the economy are not as strong as we've been told it is, and unemployment continues to go up at this rate, which is pretty quickly, what's that going to mean for rates, Mr. Skelly?
Yeah, so unemployment has a big impact on mortgage rates because probably unemployment and inflation are the two biggest things that really affect it. And so I think it was 3 weeks ago we were having a show and there was a Friday report that had come out. That was, I think it was August 5th or something like that. And that was when we saw the big jump in the unemployment number. And I said on the show at the time, this is a big deal. I think it's going to have a big impact on rates. And it did. We saw average 30-year was at 6.87 on July 23rd. And then on August 6th, right after that unemployment data came out, it had dropped down to 6.52. These are from the Mortgage News Daily survey. Hasn't changed a lot since then. So the market doesn't seem to be too spooked by some of the revisions. This week, the jobless claims came out. It was 232,000 versus 230 forecast. So generally, when the numbers come out and they're in line with what people are expecting, it doesn't move the needle too much. But that unemployment number at the beginning of the month was certainly higher than people were expecting, and it did make rates go down. And that is, that's a big part of why everybody's forecasting that they will cut rates. I did see one article that said the market had lowered the chances of so they can either cut rates 0.25%, which is pretty expected. 0.5% would be a big cut. And I saw one article that said the market had changed the chances of 0.5% rate cut from 36% down to 25%. So I think the reason that folks are saying that is they're expecting to kind of slow, they increase rates pretty quickly because inflation was at 9%. They had to act and make things move quickly.
Well, they had to go quick because they waited too long after they encouraged the government to spend $2.3 trillion of unnecessary dollars.
Yeah, no, I mean, I agree. They definitely caught them by surprise. They didn't see it coming for sure. And so then they had to make pretty drastic reactions. But I think they'll probably, they're worried about slowing things down too much, especially with unemployment on its way up. So, a lot of folks are predicting, and I agree with this, that they'll probably do a series of quite a few small rate cuts. And I agree with you. If we see another large increase in unemployment, we can expect rates to go down more significantly and faster. And we'll see what happens.
Well, I'm hopeful that the Fed won't make the same mistake that they made at the beginning of all this. If you remember Jerome Powell, you can go back and listen to Powell, who says he's never political. He says, I'm never political. I'm a straight and narrow guy. That's what the Fed is all about, being not partisan, being, completely separate from politics. But if you remember when the new administration took over, he encouraged the new administration to print that $2.3 trillion. In fact, he said, this is going to be the last time you're able to ask for money because we're seeing, an end, meaning inflation is coming. And so he actually encouraged the government to ask for as much as you can. You're not going to be able to ask for more because we're just not going to be able to print more money with where things are heading. He encouraged that last 2.3 trillion, which ultimately put the Fed in the position that it found itself in, which is dealing with high inflation. It was a lot to do with Jerome Powell's encouragement of going out and grabbing an extra unnecessary 2.3 trillion, which was called the infrastructure bill, but there was so much other things wrapped in there, partisan agendas that were wrapped into that. There was a bunch of COVID stuff that was wrapped into it. COVID was well over at that point, and that just poured gasoline on the fire as it relates to inflation. Then the Fed waited too long to react, right? Like, we were told during COVID, we're just flattening the curve. We were told at the beginning of inflation that it was transitory, or what was the word they were using there?
Yeah, that does ring a bell. I mean, it had been like 40 years since we'd had any kind of serious inflation. So, I mean, I think it's like people just forgot that this could be a problem.
Yeah, I mean, but in those 40 years, we never printed, 60% of the money supply either. I mean, we just, completely went absurd on the money printing machine. And so, anyways, now we've got inflation back down. We can't, force the economy into a recession when housing's been in a recession. And so if you keep housing in a recession as long as you've done, that always leads to recession. Those recessions, you start losing construction jobs. It impacts so many different people. You can't just keep hiring inventing new government jobs every month to continue growth. The growth has to come from the doers and the entrepreneurs in this country. That's what makes this country so valuable. And, right now the Fed is playing with fire with where these job numbers are at. And if they don't cut soon and start cutting significantly, we will be heading into some difficult times in the economy. As real estate goes, Zillow's got a forecast out. They've seen slower growth on appreciation. When I say we're in a real estate recession, I'm talking about transactions going from 6 million down to 4 million. Talking about interest rates rapidly going up. All those things, when you bundle those together, they classify a real estate recession. The recession prices can go anywhere. How many people can actually afford those prices is another story. Right now, Zillow has prices going up not all that much over the next year. Year over year, their newest projection is 0.9%. Month over month, their next projection is 0.1. Remember, Connecticut's been up double digits in the 12 months looking backwards, okay, 10+%. For Zillow, where they look at Connecticut, let's take a look at a couple of the Connecticut regions here for Zillow. The region of Bridgeport, they only have going up 1.4% on a projection moving forward year over year and 0.1% month over month. That's well off of the 10 and 12% numbers that we've seen in these rankings in Connecticut looking back over the last 12 months. Let's take a look. Let's take a look at Hartford region. Let's see if we can get that here. Yeah, here we go. The region of Hartford, year over year projection will be 2.4% on this new Zillow report. Month over month, 0.2%. And let's see if they don't have they have a New Haven. They don't have a New London. New Haven, they have going up 3% year over year and 0.3%. So Zillow, taking into account maybe where this economy is heading, has kind of, and really where we've seen some of these gains. We've seen inventory go up across the country, and is putting out some lower numbers. Last year's numbers they had were 6%. That was right on the money for national, 6%. Obviously, Connecticut saw much bigger numbers at 10 and 12% home price appreciation. There's your Zillow update there on where they're forecasting prices.